One of the biggest bookkeeping mistakes I see real estate investors making is they put their earnest money deposit directly into the building category, as if they already own the property. Let's say you drop $20,000 as earnest money, but people book that under property right away. But here's the truth: you don't own anything yet. The money is just a good faith payment, not equity. So the big question is, if it's not part of the building, where does it really go in QuickBooks? Stick with me, because in this video I'll show you step by step how to do that. So the big thing, what is earnest money deposit? It's basically a placeholder. It's nothing more than you reducing your cash account by, let's say, $20,000. You're reducing that and then transferring money to a third party, say an escrow account, the attorney, or whatever, so another third party, and you don't have control over that money anymore. So the $20,000 decreases your cash account, which you have control over, and transfers it to a third party escrow account, which you don't have control over. That's really the only difference. It's still an asset and everything, you just lost control over it. But what it is doing is it's a good faith payment to, the buyer, or showing the buyer, not to the buyer, but showing the buyer that you're serious about buying this property. Now, the problem is it comes before the closing disclosure, and it comes before the HUD statement and all those paperwork that is pretty much the receipt of buying a property. And the problem with that is before you get your receipt, you'll make that deposit, say in QuickBooks, and you don't really quite know what to do with it. So obviously it's gonna go to the property's value eventually, so you'll just throw it in there. But it's not really how you do it. You have to put it in a placeholder account. That way, whenever you get the HUD statement, it flows. You can see it on the HUD statement, and you can still create a journal entry, and it all balances. And I'll explain that more in the next video, but for now we'll just focus on the earnest money deposit. So how do you do that in QuickBooks? Well, let's dive in and I'll show you exactly how. So first and foremost, if you haven't already, you're going to want to create an earnest money deposit account. I've already created mine right here, and I've put it under the account type of other current assets because it's current. It's gonna be transferred out of here in less than a year, so you don't want to put it as long term, and it's still an asset. It's still yours. You can still get it back. And now that's where the stipulation is that it's still yours because you could still get it back. And remember that part, because we'll discuss that more here in a little bit after we just set this up. Now, after you've set this up, let's say you've found a property, you like the terms and everything, so now you're ready to send your good faith payment as a deposit to your escrow account that shows the buyer that you're serious. So you're going to set up a journal entry, and you're going to say, I'm going to debit earnest money account because I want to increase it. So we're going to put $20,000 on my earnest money account, which will increase it. And then where's that money coming from? I need to credit my bank account because that's where I got it from. So it's coming from my bank account, so it credits my bank account, and then it's going to my earnest money deposit, my debit account. And for the class tracking, like the last videos I've showed, we're gonna put this in, we'll say 28 Grissom Place, so that this money will go into that property because that's where we're wanting to put it, and then this comes out of my general business, and then we save and close it. So what that's gonna do is if we come over here to my class report, sorry, it's going to show that it's underneath the 28 Grissom Place that we did it under. So general, my bank account reduced by 20,000, and then right here underneath 28 Grissom, my earnest money deposit has increased by 20,000. And that's exactly what you want right here. You don't want it to see it down here under buildings, because this is a fixed asset. You know, you don't want this because you still have a chance of getting this back or losing it depending on what happened in the future. That's why it's being held by a third party. That way, you know, there's no contestant of the money. You know, you've gotten it solidified. So what happens if you know, lose the money? You know, if you back out of the deal for no apparent reason, they can keep it. The seller can keep the money if it doesn't line up with your contract. Well, you're just gonna, you know, expense that, and that's gonna be an expense for you. You know, you can put the account of whatever you want, you know, I can't think of one right now. But you're just gonna name the account however you're gonna see it, like lost money or something like that, like bad deal, lost money. Or if you say it, you know, the deal falls through, but it's for reasons that are underneath the contract. It's like, you know, the foundation was found to be way worse than what it was supposed to be or something. So it was going to be too much of a headache to fix. So you're like, hey, I can't do this anymore. Well, that deposit's going to come back to you. So in that case, you're just going to reverse the deposit. Now, that's all good and well. Now we've got it set up. We've got the money in our earnest money account and everything. Now comes the next step. Let's say everything works out perfect. We've come to the closing table. We've got our closing documents. We've got our closing disclosure. We've got our settlement documents. Everything's all ready to go. Now, here's where it all ties together, because now that we have our HUD document or our settlement statement, we can see on there that there's an earnest money deposit, and that's going to be rolling into the value of the property. Now, that is going to be beyond the scope of this video, because we're going to discuss that in this video right here. So watch it.